Welcome to the PI World interview recorded on the 8th of July 2021. And I'm your host, Tamsin Freeman, and delighted to be joined by the very popular Richard Leonard, who co-runs the family office Trium. Richard will be generously sharing his views on the markets and specific stocks, and you should assume he owns any of the shares he talks about. So, of course, do your own research if they are of interest to you. Richard, many thanks for joining us. So what's your performance been like year to date for 2021?
It's been good, better than I would have hoped for. Year to date on a sort of like-for-like clean basis, between 40 and 45%.
Wow.
Positive year to date. Admittedly, if you attribute it, sort of half of that's coming from one holding. And dare I say it, you're not going to be surprised at that name. It's Reach. It's Reach, which started the year at 143, I think. When we spoke with Andy Brough, his top pick was Tremor. That's more than doubled easily. And Reach, I think at the time was 80-90p in November. Finished the year at 143, and today, it's 285. And I'm still very bullish. And it's 25% plus of my portfolio.
Wow. Have you bought any more?
Yes. In the last month, we've continued to buy, and maybe I'll touch on that a little bit later at the reasons why.
Okay. So when we last spoke in December, you were quite bullish about UK equities. You thought that Brexit had been a dampener, and you thought obviously COVID had caused issues. Are you still as bullish as you were then?
I am bullish still, although there are clearly hurdles that we need to look at, and we'll reflect on that in a moment. Year to date, global equities are up 13-ish%. FTSE is less than that, maybe 9.5-ish as we speak. But remember, it's more defensive. It's got pharmaceutical in it, tobacco, a lot of banks, although the banks should be well placed here relative to that point on Brexit and relative to the fact that interest rates will be going up as we progress through the cycle. And if you go back to August, that's when I really believe we had the start of the business cycle. So please don't worry about it. The economic recovery is still on course. As we reopen with the vaccination programs, almost certainly governments around the world will look for herd immunity. And that is probably why we're seeing the COVID cases going up and hospitalizations. But it's the right time of year for that to happen. So the economic recovery still on path. GDP this year in the UK will be almost certainly north of 6-7%. Keep an eye on PMI data out of places like Germany and Europe and the UK and the US. In the US, that would be the ISM that you need to keep an eye on. And that growth recovery will continue. And you're certainly seeing that in the States with the airline industry, because they're all in effect, going on holiday within the United States. So long haul is not the case in point for now. It will do in due course, and therefore, if I'm bullish on economic recovery, I would clearly still be bullish on the cyclicals, which I am. But within the UK, you're going to see strong domestic recovery as well. We're seeing that from the housing market. You'll see structural change going on, work from home. So that will tie in with the housing market nicely for things like furniture retail. So I'm a big fan of DFS, although I don't own DFS at this present time. It's a brilliant company. And if it were to have a correction, that would be the sort of stock that I'd buy. Without question, though, we're going to have lumps and bumps in that economic recovery because clearly, with the vaccination program, and if government do want to follow the herd mentality, then they're clearly going to have a lot of COVID cases coming through the piece. So in the near to medium term, I want to stay away from those lumps and bumps, those uncertainties. What do I mean by that? Well, I'm not investing in leisure. I'm not investing in airlines. I'm not investing in hospitality or restaurants or pubs. I just think it's too uncertain exactly what consumer behaviour will be around this recovery pattern post the vaccination programs, which have been a real success, not just for the UK, but the world in general. The United States, Europe admittedly catching up. And therefore, I still want to look for those certainties in terms of where I'm investing money. Remember, Richard Leonard only has a portfolio in essence of 16 companies. As it is, at the last count, it was 15. So I need to think about that relative to my next stock pick. And maybe we'll talk about that a little bit later in terms of my recommendations right now. But the themes and trends very much still the same as I talked about in December. Work from home, the digital world is still running at a pace and will continue to do so. And I tie that in with some stocks that I own at the moment. And as I say, I'm still bullish the cyclicals as well, industrial cyclicals in particular, as we see fiscal expansion from governments, whether it's in the UK, the US, and the rest of the Western world, take course. And that's a good example of why, for example, here at Trium, we took a very big position in Kier, which is another one of my holdings at the moment, which I believe will continue to see upgrades after its refinancing sort of about a month ago. And so very much still very the same as my thought process back in December.
So where are the opportunities? How can investors take advantage of the market that you're seeing at the moment? What are you buying?
My approach is very much bottom up. I'm a fundamentalist. I'm a stock picker. I look at business risk, financial risk, and ultimately valuation risk. How do I make money? But at the same time, I still use that business process investing that I learned at Casanos. And given that point I made earlier about being at the beginning of the cycle, the business cycle, that's really what I'm still looking at. And I want certainty. That's why I'm staying away from those areas I mentioned, airlines in particular. I'm just not clever enough, and they're capital intensive, which I don't like either. So I want to be at the beginning of a business cycle with companies that are well invested, that have got evidence of pricing power, that have got good brands, and that DFS really fits that. Although I don't own it at the moment. Why don't I own it? Well, maybe I should, but I'm buying something else that's aligned to DFS, which I'll touch on later. But it would be that type of company that I would be looking for. On a reflection since last August, markets have been volatile at different times. Month to date, 12 months on 12 months, FTSE's up sort of 12.5%, 15.5% around that measure. The mid 250s double that, about 30+%, 32%. While the S&P and NASDAQ have just hit near-term highs. What I'm nervous about, though, however, is the US Treasury market, because back in April, people were fearing inflation and suggesting that the US 10-year would go towards 200 basis points, 2%. And yet today, it's down at 126. And that's sending very different signals to me, which I'd absolutely be frank with you, I don't fully understand. So I still have this little cautious thought about government bond markets in particular, because only a few months ago they were fearing inflation. Now they're clearly fearing something else. Maybe that post this recovery of COVID, that we go into a sharp recession as interest rates move up, as taxation increases significantly, because after all, someone's going to have to pay for all of this. There's undoubtedly been a massive transfer of wealth across from government purses, government balance sheets, across to private wealth. And that's, whether you've been furloughed and you've been able to sit at home on the sofa, or for that matter, whether you've been a private investor like Richard Leonard, who has more than doubled his money in the space of 12 months. I've more than doubled my money in the space of 12 months. That's never happened to me before. I've come close, but I've never done that before. In a diversified portfolio of approximately 15, 16 companies, that's extraordinary. And it's really via stock picking. And I'm still of the belief that it will be stock picking at this point in the cycle, the bottom up approach, that will make you money. If you do your own work, if you go and investigate and interrogate, go onto websites, look at the RNSs that are released by the companies, on a consistent basis, and watch the trends and themes. And around that, that's how I build my portfolio.
So what are you buying at the moment? Take us out of our suspense.
Well, I mentioned earlier, we've actually, and I've actually over the last 6 months and only recently added to Reach, the stock I recommended with Andy back in November, Andy Brough back in November, and I'm still a big bull. Well, I must be. It's my biggest holding, over 25% of portfolio, and it's our biggest holding at Trium as well. Back in October and November, it was 80, 90p a share. Today, it's £2.80. So what am I expecting? I'm expecting the trends to continue. I'm expecting within the business, that transformation program that Jim Mullen is pushing through. I've become a massive fan of his finance director. I think his finance director could be one of the best FD in the FT All Share outside of the FTSE. No, actually, I think he's better than most of the FTSE FDs as well. And so that transformation program, that cost cutting that Simon Fuller drives through as well, and the digital strategy that they're following with the Reach ID, which is really kicking in. Now, remember, advertising for choice is quite opaque. The real skill is finding as many eyeballs as you possibly can and then keeping them and reselling the same idea of what people should be buying or doing in their life. And Reach are brilliant at that. They get to 42 million people after all, and they're now monetizing it at a much better pace. And so you wrap that all in to the cost cutting and the strategy that they're following. I expect more upgrades. I expect this stock to continue to revalue. And sometime between now and the year end, I'm expecting this stock to be nearer £3.50 and maybe more. And so there's a lot to go for. We've got results on the 26th of July. It's been a massive winner for me, and I don't want to sell it. I've been buying it.
What earnings are you expecting?
For this year, I expect earnings upgrades against the analyst forecasts. If anyone can get hold of the Numis note that Gareth Davis wrote about 2 months ago, extraordinary piece of work. And he does some really fantastic scenario analysis around the top line. And the interims that report on the 26th of July, I believe, will be the first time since 2005, that this company will show top-line group revenue growth. And admittedly, that's from the relaxation of the restrictions, and the print side of their business will be recovering at a pace. And I'm boring and dull. I wait outside Sainsbury's on a Sunday morning. I watch all the people coming out with their paper newspapers. So the physical print's still there. But that transformation program that Jim Mullen's bringing through, and I mentioned Simon Fuller, I've got to say that I think Jim is almost certainly one of the best gurus, if you want to call him that, within the print advertising arena. And after all, that's principally what Reach is. And it's re-transforming itself into the digital world. 35p of earnings this year is the market forecast for this year. I think it will be near a sort of 38, 39p. So that gives me that earnings momentum that I always look for. But the other side of the coin is I always hope for a revaluation. And I believe Reach will get a revaluation. And as I jump out over the next couple of years, those combined forces get me to believe that this stock could easily be worth £6 a share in the next couple of years. So why would I be selling it? I want to buy it. The thing is, however, it's a quarter of my portfolio, and you've got to have some diversification for choice, and that's what I've been doing. Polar Capital has been a real winner. Still own Polar Capital. Had a fantastic meeting with that management team. They built a brand without doubt. They're still progressing with the strategy in terms of building out teams. The inflows now are positive. Within the first 8 weeks of their new year, they've added about 500 million on top of the 20 billion that they finished with in March. They've got a balance sheet full of cash. They pay an excellent dividend, and the stock deserves to be re-rated. So I'm not buying Polar here because I've got a holding, but I'm still a big fan.
Have you been selling it as it's moved up?
Yes, stupidly. But the nature of the way I run portfolio is that I'm looking for the next winner. Luckily, I found it in Reach, But Polar Capital, it actually got me back on the bike, as I described it when we spoke back in August. And back in May, June of last year, I was still about 90% cash. And Polar was the opportunity that got me back into the market, if you like. The realization that we were going to be at the beginning of the business cycle. They were going to cut interest rates. They were going to add to the mountain of QE, which at some point they would withdraw. And I think that's what the bond markets are telling us. The bond markets are nervous of how the economic activity levels will progress as restrictions come up within the COVID world that we clearly now live in. What else have I been doing? Redde Northgate. I don't own Redde Northgate anymore. Fantastic set of numbers the other day. Again, I sold it too early. If anything in my career, I have found that I have sold my winners too early. But the principle of investing is, for heaven's sake, don't cut your flowers to water your weeds. Always find the underperforming stock within portfolio. Normally that's at the bottom end of your holding list in terms of when you attribute. And so the focus concentration that I have led me to put more money in Reach. I still have a small holding in Ultimate Products. Again, brilliantly managed, led on their digital online side of the business. They've just brought in their license agreement for Salsa, which is the weighing machines, etc., that they sell online or sell to Argos and Sainsbury's and the discount retailers, and that's progressed brilliantly well too. But the stock's been re-rated, and so I've lightened the load, and I only have a small holding left. We talked about Macfarlane with Andy, and Andy at the time, if you remember, said it was dull and boring. Well, Andy, I quite like dull and boring, especially if it makes me money. And Macfarlane, brilliantly managed, and it has been re-rated, but I took my money and recycled it. And I recycled it into that cyclical type recovery that I'm looking for. So I bought some Synthoma, and I finished buying Synthoma. I think you will continue to get a re-rating there too. I'll often say that. I own stocks for re-ratings. And Synthoma is a chemicals company. You find it in they're the base ingredients for paints and inks and colourings, and lo and behold, funny enough, that fits with the housing cycle that you're seeing around the world. In terms of the pigments, etc., that they help pregnate into the paints, etc., that we buy from the likes of Wickes. I own some Wickes as well, which demerged from Travis Perkins. I think it's simply too cheap. It's very well managed. And again, it's in that business cycle part of the economy, in this case, the UK consumer, where people want to improve their homes. Why? Because they're at home more. And the work at home strategy seems to fit with my process at the present time.
So have you sold Novacyt, or what are your views on Novacyt?
I still own some Novacyt. I did reduce. I had to, really, because one, I made an unbelievable amount of money very quickly, and so I naturally reduced into the rising levels. But I was a believer of Novacyt, and I still am a believer of Novacyt, but I did reduce, and I still own some. The problem is the contractual arrangements, contractual relationship that they had with the Department of Health and Social Care. And they basically got blown out of the water with an invoice worth £129 million, which government aren't paying. So, just took it straight off the top line, and they've had to make a provision for it as a consequence. And they are in now discussions with their largest customer. And what it showed me was that be careful of your customer concentration, point one, and point two, be careful when you're dealing with government, which makes me nervous for choice of those types of companies. And so I do own some Novacyt still here at Trium, but it's a quarter of, it's not even that, it's probably 20% of the original holding. But remember, when we started buying Novacyt, we were buying Novacyt at £4, £5 a share, and we were able to sell it at £9, £10, £11 a share. Now, and I'm glad I did, and that's a discipline that I've got, and that's often why I don't own the winners for longer. But in the case of Reach, that's not the case, because I just think there's too much upside in the near to medium term.
So with Novacyt, was it a question of it hitting like a psychological stop loss that you felt that it was right to get out at around £9?
No, we were selling it when we were still in a massive profit. What came left side was the contractual disagreement that they had with the Department of Health and Social Care. And as a consequence, they lost revenues of £129 million. The invoice was and has not been paid. And I had a conversation with Novacyt in the last couple of weeks. Where they sit now is that the forecasts are very believable, because there's nothing in the forecasts for UK government work.
And do you think they will get any and get paid for it?
Yes, they will get some, because they're dealing direct with the NHS hospitals, which that's a different relationship to the department, the central department, that was Michael Hancock's responsibility. I won't say any more.
And you won't be buying back in?
No, we will actually. We will actually, because in valuation terms now, it just looks absurdly cheap. But it always did look cheap relative to its revenue growth. The problem was that revenue growth suddenly that revenue that we thought was booked for 2020, the second half in particular, disappeared completely. And they are now in disagreement with the current year revenue as well. So that's a real problem, and that's why the forecasts don't include any government revenue, UK government revenue. It's all private and overseas. But Novacyt are doing business directly with the NHS hospitals. Surprise, surprise. Why? Because the product is exceptional, and the costing pricing is very feasible for those hospitals versus the competition. So in terms of value and in terms of efficiency and accuracy, it's ticking all the boxes. But the problem they have is my understanding. The problem that they have is with the government Department of Health.
So you don't think they've failed on any side of their contract?
That's what I'm being told. That's what I'm being told. That's what I understand. And so at some point they are going to have to sort it out. I mean, it's my biggest loss this year. On a mark-to-mark basis, it's my biggest loss. But when you've got Reach that goes up from 140, it's doubled. Reach has doubled this year, and it's 25% of my portfolio. So that's really what I've been up to, and that sort of leads us on to what am I looking at now?
And tell us, what are you looking at now?
No, I couldn't wait for this. I'm actually really excited, because about a month ago, if you'd come to me and said, well, what are your best ideas right now? I would have found it quite difficult, if I'm being honest. And markets are going to stay volatile. And so I definitely want to be in businesses that I believe are well managed, that I believe have got strong balance sheets, and that there is a valuation that I can understand. And I often say to myself or to a stockbroker, or even to you and I between each other, how do I make money? And that's principally the last question I'll ask myself. About a month ago, JP Morgan and Morgan Stanley floated a mid-250 company with a market cap of approximately 750 million. As it turned out, they thought it was worth significantly more. They just didn't do a very good job. And really, JP Morgan and Morgan Stanley shouldn't be floating UK mid-cap companies. Now, Andy and the others in the fund management community may not confess to that. I can. You should really be at the higher quality end of the mid-250 broking arena, and that's people like Numis, people like Investec, people like Peel Hunt. And JP Morgan floated Made.com. Now, this is a fantastic brand that's been created over the last decade. It's incredibly well managed with really experienced brand managers. And this, in effect, is an online brand, so it's got no physical space. I like that. That's capital light. They created a brand, and this brand is online. It's a disruptor. It's a vertically integrated player, i.e. it designs, sells, and then sources its manufacturing. and its manufacturing is all in the Near East, Europe, and the Far East. And most of the furniture and alike that we buy, we're buying it while it's been designed and it's on the water. It's high order. What do I mean by that? It's not competing with DFS for choice. It's not competing with IKEA, which whenever I go into an IKEA store, I go dizzy. I really do. I have to run for the exit. And so this is a design team that's hugely creative. And the business model, absolutely, I adore the business model. So the creative designers, in effect, have a royalty stream commission in terms of their success failure of the product. It's got negative working capital. Even better, this gets better. But more interestingly, the point I made earlier, why I went to have a look at it, was because it looks a bit like a failed flotation by JP Morgan and Morgan Stanley. Now, that doesn't surprise me. So I spent 2 or 3 weeks looking at it. And what I liked about it is I just mentioned around the fantastic business model. But what I also like is that this is blowing the doors off in terms of its top line growth. It's growing at about 30% per annum on the top line.
What sort of revenues does it have, and profit and earnings?
Historical revenues running about 250 million. The present run rate is nearer 350. That tells you the growth profile of this company, the online brand attachment, and again, people working from home. And so my wife and family just want nicer furniture around them because that's where they're spending more time. And that's why I'm a big fan of DFS. But I don't want to own DFS and Made.com at the same time. I don't have room in portfolio. And this is a style business, without doubt. It's blowing the likes of John Lewis apart. And why not? Well, we can't go into their stores particularly. That's point one. Point two, John Lewis has rather stayed. And Made.com have moved into the new generation of online consumers. And they've done it brilliantly well. As I mentioned, with their design team in particular, they have low return rates, which, again, something I always look for. They've got high gross margins, over 50%. Again, something I like to look at. And actually, the margins should go better. And so when you then model it out in terms of where this business can grow, 250 million of revenue last year, run rate today 350. When I model it out and talk to the company and think about margins going forward, I think this company could be doing 1.2 billion of revenue in the next 3, 4, 5 years. And so my projection is that this company will be around 1.2 billion of revenue by 2025. Margin wise, around 12.5, maybe slightly more of EBITDA margin. If I discount that back, that gets me to a share price target of well in excess of £3 today. And so I think you could double your money in the next 2 years in Made. It's very well financed. That was the reason for the flotation, and that's the good job, in fairness, that JP Morgan and Morgan Stanley did. There's a very good analyst on the stock at Leveram. I spend a lot of time looking at his models. That's what I do. I like to interrogate and filter and play around with numbers. And if anything, I think he's lighting his numbers for the current year and for next year. And we'll have to wait and see. They report, I believe, in late August, early September. But my expectation is that Made will have real progression at the top line, led out of their new established growth areas of France and Germany, still growing in the UK, and still building that brand, which they've done incredibly well over the last decade. And so Made.com, I believe, is in effect, for me, it's made in heaven. I think I'm going to double my money in the next 2 years.
Did the founders sell when they IPO'd, or did they sell anything?
No, I don't know enough history of that. I need to look into that, to be fair. I was more looking at the financial fundamentals, but the management team history is outstanding. It's been back. That's a really interesting point, though, you raise, because it's something else I look for. It's only had £63 million of equity investment to get it to the point that it's got to. The 250 million historical revenue, today it's running more like 350. This time next year, it will be north of 450. And by 2024, 2025, I believe this business has the opportunity, potential, to be running at a 1.2 billion plus, by which time the economies of scale really come through. And can you imagine the cash that goes through the till? A lot of it they keep and retain. And that's what I love too, the cash generation of these businesses, and built around a brand that people recognise and have real knowledge of. And one of the first things I did, because I'm not fashionable, you can tell that from the sort of jumpers I wear. So I asked my daughter, and I asked my stepdaughter, I said, would you buy from, oh yes. Why? Oh, it's quirky, it's different. That's where John Lewis are behind the curve. And more importantly, it's disruptive because it's online. And online penetration has increased by at least 50% on the measure of retail sales. It's running at 30-40%. And so going forward, it sort of ties in with my investment case for reach. And remember the point I made about advertising, it's finding as many eyeballs as you can and repeating the opportunity to sell them as much as you can. And that's why Reach have done so well in terms of understanding data and building the attachment into those eyeballs. And so I think we will more than double our money in the next 2 years. And I've been buying the shares consistently over the last month. And again, if you remember, I generally take about a month to buy my position. And the reason, because I need to feel comfortable. I do more work, I do more thinking around the investment case. And if I still own a stock after 29 days, don't ask me why, it just happens to be 29. I've got an 80% chance of being correct. So I've owned Made for about a month. I'm still buying it. If it dips, it got floated at £2. I think it will finish this time next year nearer 3, and 2 years out, I think the stock will be nearer 4.
Fantastic. I could ask you more questions on that, but I know you've got 2 others you want to talk about and we'll run out of time. So tell us the next one that you've been buying.
The next one is a bit like Macfarlane, and Andy Bruff round at Schroders, who's a fantastic fund manager. He runs 6 odd billion. He has to own 240 odd companies. I wish him all the best on that. Because I find it difficult enough to remember 20 at any one point in time. This is boring and dull, but it's fantastically well managed. The company's Devro. Okay, market cap wise, it's about 350 million. And now Devro, in the early mid-90s, floated with the great house of Casinos. I was a Lazard fund manager, and this stock was always rated on, a significant premium to the market, 17, 18 times. And the reason was because it basically, with its competitor, owned the market. What does it do? It does sausage skins. Sounds boring, doesn't it? But it's not. They have to spend a huge amount of R&D every year, because a sausage skin is really important to the underlying taste of what you're eating, i.e. the meat, whether it's beef or pork. It's only got one competitor, and they basically own the market. And this is collagen, okay? So this isn't sheep gut, which really destroys the taste of the meat, in my view. And yet sheep gut is still 40-50% of global markets. And the Chinese in particular have worked it out too. They like their food just like we do. And foot and mouth admittedly hasn't helped. And Devro and their competitor, Fiscal, which is Spanish listed, is more mundane and cheaper and commodity. But the two of them own sort of 70-80% of the market. And you then got that conversion away from meat gut in favour of collagen. And so on the basis of the margins and on the basis of the rating, stock market rating that it has with its major competitor, it only trades on approximately 12-ish times earnings, 13 times earnings, whereas its Spanish competitor trades on 17, 18. Why, you ask? I'm sure you're going to be asking why. And the reason is because in about 2015-16, they had this great idea of going over into the US, which is one of their major markets, as is the UK, as is Latin America, as is places like Russia, for Devro. And they decided that they were going to increase their manufacturing facilities in the US. I believe it was Kentucky, but maybe go and check that. And they went and spent a wodge of shareholders' capital. and absolutely bastardized it, so to speak. I shouldn't use that word, I'm sorry. But they created a real problem for themselves. And they've got very high fixed costs in this business. Peel Hunt have only just written on the topic, actually, an analyst called Charlie Hall, and he knows the business inside out. And the suspicion here is that this company is going to have more upgrades. And what happened in 15-16 was that they completely screwed it up. They put new manufacturing technology in, and guess what? It didn't work. So they lost service levels, they lost utilization, and because of those high fixed costs that I talked about earlier, fixed costs in this business can run at north of 50%. So it's all about volume. Well, we've got volume coming back our way. After all, these guys find themselves into hospitality and alike, and also clearly people at home who want to eat better. And so Devro, with their competitor, their Spanish competitor, are in somewhat of a virtuous circle in the near to medium term. They're generating an awful lot of cash as well. And historically, that cash went against the wall because of the problems they had in their new manufacturing site in the US. I mentioned the areas that they're involved in, places like the UK, Europe, Latin America, North America, and these are impregnable market positions. They've got real pricing power too. And I believe this pricing power is going to lead through into better profits and turnover because volumes are recovering as well. So I've got everything in my favour. I've got a valuation that's too cheap. I've got a recovery of revenue. I've got an increase in margin because of the economies of scale. Oh, and lo and behold, I've got a management team that I believe in. But I only believe in the management team today. A few years ago, I questioned it. And I think because they overpromised. And I think the management team now at board level have worked out stock markets like to be surprised on the upside. And so they've always left a little bit back. And so the momentum in the business is strong. The pricing power I talked about, and the volumes are coming back because of the cycle of people going back out and being entertained, etc. But at the same time, wanting a better quality of life. I go back to that taste threshold of edible collagen. And so Devro, with its market position, its valuation, simply too cheap. And lastly, on the investment case, I can't believe that venture capitalists, private equity, aren't looking at this. And I'm not suggesting it happens, but I wouldn't be at all surprised if I come in the next 12 months and find the stock taken out because of its characteristics that I've just mentioned. I've been buying the stock over the last 2 weeks. I will continue to buy the stock. I think the stock's worth today £2.40, £2.50. So I'll continue to add to the position up towards the 220 level.
And the debt and the pension don't put you off?
The pension's going in your favour. It's not a huge pension deficit. You need to look at it without doubt. The cash flow is very positive, and actually, given where we are in the business cycle, given where bond yields are, although I've got that big question mark over the US Treasury market right now, no, it's fine. And the debt's reduced. The debt will be sub 100 million for this year, and then will fall considerably. So in terms of an EV/EBITDA sort of cash flow multiple, call it that, it's on 6 times. It's on 6 times. It owns its market with its Spanish competitor, where margins are 15-16%. It's just ludicrously cheap. And hence my point. I can't believe that VCs aren't crawling all over this. We all think that these VCs, venture capitalists, are really smart guys. Yes, they are. But then they're not much more smarter than me or Andy Brough or the market generally. But the problem with the stock market, it undervalues companies. And this is the reason for Devro. The reason I'm buying Devro. Devro is significantly undervalued, and I'm buying it.
And give us your third pick.
My third tick, you're going to yawn when I sort of say, do you know what? It's very similar to Reach.
But and can you have that in your portfolio? If Reach is such a large part of your portfolio.
I'm having to make room for it. And I haven't told you the name of the company. The market cap's about 70 million. So I've got to be somewhat limited to the amount I can own because of liquidity. At the same time, Trium, in its own right, mighty Trium, as we like to refer ourselves as, mighty Trium own a declarable stake in National World. Now, National World is in effect a different name for Johnson Press. And Johnson Press is regional newspapers, an absolute darling of a company in the 90s and early noughties that went very wrong. Why did it go very wrong? Arrogant management who didn't wake up and smell the coffee in terms of the internet, in terms of the way the digital world was ultimately going to evolve around the way we go about advertising. And as a consequence, they stuck firmly with the physical paper, and they went very wrong. And they then got geared up to the hilt in debt that they couldn't repay. And remember, one of the things I absolutely hate is too much debt. And so Johnson Press, in effect, went to the wall, got taken over by distressed bondholders. Distressed bondholders don't know how to run newspapers. And luckily, a man called David Montgomery, he does know how to run newspapers. And David Montgomery, who in effect has had a number of successes, he helped build Trinity Mirror in the 90s, and he's done other exercises in this area and made significant monies. And he, in effect, bought the Johnson Press assets, which are things like the Yorkshire Post, the Scotsman, the Portsmouth News. They've got a number of titles. And what he's having to do with it, he's having to restructure it, take huge costs out, and then invest those cost savings across into, funny enough, digital. So it's a transformational story in a similar way to Reach, but it's very focused. It's all completely focused on regional newspapers, which in their day were darling companies. It doesn't have the red top presence such as the Mirror. So it doesn't have national newspapers at all, and it's cutting out huge costs from the business. They bought this business for an outrageous sum. They had for £10 million back in December off the distressed bondholders that didn't know how to run the business. They've already taken £4 million out of costs in the business already. The revenue was running at about 85 million. It was making 6 million of EBITDA. Well, I've just said they stripped out 4 million and they've invested 2 back into digital, which is growing now at a pace. And this is a margin story. This is a cost restructuring story. But more importantly, this is a digital transformation story. And I would gauge this to be 4 years behind that of Reach. The real excitement, though, is that the world's worked out that Google and Facebook aren't quite the people we think they are. And what they've been doing is they've been taking journalistic content, the owners, that people like Johnson Press and Reach own, and it's another plus for Reach as well, and they're having now to pay up for it. So if you go onto the web, if you go onto the search engines, you can find out what's been happening there in places like Australia, in places like France, and it's quietly happening in the UK. So, if you get the chance to speak to these companies, ask them how much are Google and how much are Facebook now paying for your content. And so what David Montgomery's done is he's gone in and he's shaken the business, and he's now turning it into a very profitable business. This stock trades on 5.5 times EV EBITDA. That's like pretty close to an 18-ish% cash flow yield. I believe the stock will probably double, treble. I think it's worth 80p this time next year. It trades today at around the 26, 27p mark. Institutional investors are, coming on board now in reasonable size, and that's why the share price has done frighteningly well since they raised the money at 10p back in December. But again, when I go back and interrogate the story, when I look at the top line revenue growth recovery as we come out of COVID, talking about advertising, regional newspapers are key to that in terms of businesses getting up and running again. So classified advertising will run through at a pace. You're seeing that with Reach. And remember, Reach will report their numbers on the 26th of July. I expect upgrades. I expect the reflection on digital revenues to be very strong. And that's exactly what's going to be happening with National World over the next couple of years, combined with the cost savings that David Montgomery's put through the business. Because in essence, the distressed bondholders didn't know how to run the business. I rarely go to these types of businesses for choice in terms of their early day recoveries. But ultimately, I think Reach has taught me a lot of lessons. And that's what David Montgomery's doing. He's correcting the mistakes of the past. He's putting the investment into that transformational program. And ultimately, the stock is just simply too cheap. And I can't help myself. I think it's worth 70, 75p. And if I had some more room, I'd be buying more today as well.
And what figures are you basing, what forecasts are you basing your valuation on? Because I don't think there are any out in the marketplace.
Well, you don't see any because I don't give you mine. That's the first point. The second point is there is a broker. The broker to the company is Northgate. Now that's a boutique type stockbroker, but it's led by a couple of really experienced brokers. A guy called David Pountney in particular, an absolute legend. Significantly better than I ever was. And I like to think myself as a legend, but I don't touch someone like David Pountney. But he's got an analyst called Paul Richards, who is hugely experienced, and I've been able to interrogate and filter his forecasts initially. I'm actually more bullish on revenue. I think he's more bullish on margin in the near to medium term. This business, something I didn't mention earlier, this business has 16 plus million of net cash on its balance sheet. So you've got a market cap today of, there's 260 million shares in issue. You've got a market cap of around 70 million, but I've got to net off the cash. And these businesses generate cash on those types of margins. Now, there will be ongoing restructuring. There will be ongoing working capital considerations. But it will also give David Montgomery, the chief executive of National World, who's got a big shareholding, something I always look for. People like Lion Trust also look for that. And so he's got his hands firmly on the table in terms of ensuring that he delivers. He's got room to also acquire, and I think David will buy data-led businesses, in that catch-up phase that Reach are doing as well. So the EBITDA growth will be significant, and that's where I get the forecast from. Initially, I got them from Paul Richards, who's an outstanding analyst with real experience and knows this area, this business extremely well. And then I've met management. I meet management as many times as I can, especially when I own the stock or when I'm looking to own the stock. And generally speaking, I do 2 or 3 weeks work. I start to build a holding, and I'll either continue to build that holding, as I've been doing with Made, for example, or certainly Reach, and I'll build that holding, and if I feel it's right, I'll continue to add to it. It takes me normally about 4 weeks, 5 weeks to get the holding I want.
So for us as retail investors, it's very difficult for us to research this one because there's absolutely nothing out there. So I think we're rather in the dark.
Well, they will report in early September, and that's the time where private investors can have a look. Hopefully, maybe you could get hold of David Montgomery and do a webcast. I think that would be very useful. And I don't think companies do that enough, because the private clientele now, the platforms like Hargreaves and AJ Bell, etc., are giving people the opportunity to manage their own pension funds. I manage my family pension fund for both myself and my wife, and it really gives the opportunity to invest, directly, and it would only be right and proper for them to look after the private investor as well. And we think the private investor today is something like 25% of volume of the London Stock Exchange. And that's difficult to prove, by the way. It's just my estimate. But you can see it. You can see that the volume going through in small shapes, as I call it, lots through the stock market, and that I think gives scope, reason for smaller companies like National World or like the Devros of the world or Made. Made's only just come to the market. There isn't that many forecasts out there too because it's a recent IPO. But that's where the opportunity is as well, in terms of understanding and measuring it way before the institutional investor. Because after all, they can be very slow to maneuver and they don't have the same advantage in terms of liquidity. After all, I may run a quite sizable pension fund now for both my wife and I, but in essence, I'm not competing with Andy Brough, who has to run 6 billion.
Yeah, Absolutely. So your one negative, I think, is really what's going on in the bond market. And if it didn't go well, how would you see that playing out?
What I'm saying about the bond market is I don't understand what it's telling us. A few months ago, everyone was banging on the drum that inflation was a real risk, that it wasn't, as we pulled out of COVID, as economies reopened, and that it wasn't transitional. Personally, I think it is, but there will be some long-term inflationary aspects that won't go away. Food will be an example where I just believe food will be inflationary for considerably longer than policymakers would like. Another reason, by the way, why I'm buying Devro. So the bond markets I'm not fully understanding, because back in April, May, the US Treasury was running at 1.65. Everyone was banging the drum, oh, inflation. And even I was thinking about owning gold as a hedge, and I've never done that. I've invested in gold alternatives, such as Pan-African Mining, which is worth a look, actually. It's a brilliantly run company and extremely cheap. But gold isn't my natural place to invest. And understanding bond markets right now is very difficult, because they haven't gone to 200 basis points plus. They've gone the other way. And we've got to ask ourselves why. And I think one reason may be that the market's thinking post the COVID recovery, which, by the way, is coming. We need to keep an eye on vaccination programs. We need to keep an eye on restrictions, which is why I don't like the airline industry, the long-haul airline industry in particular. But what is that telling us is potentially post the COVID recovery, we're going to a sharp recession. And I believe that's very possible. What would I keep an eye on? I'd keep an eye on the Italian and French bond markets. And if they start to shudder, run for cash. We can, after all, because we're private investors. And if you remember, that's what I did back in April, May of last year, as we went into a very draconian lockdown. I'm not convinced that's the right strategy. I'm very bullish still on global equity markets, because the economic recovery is coming. But the canary in the mine for the bond markets would be the French and Italian bond markets, for me. That's my personal view. And if they were to become shaky and questionable, like if you remember in 2011 when we had this sovereign debt crisis, and if you remember, that was the Italian, Greek, Spanish, Portuguese and Irish bond markets. And if governments found it difficult to refinance, like I fear the Italians may have at some juncture, then you want to be running for the hills, because that will be a very testing time for equity markets. I don't think that's the case, but I'm wary of it.
Richard, many, many thanks indeed for sharing such a...
Are we done? Have we finished?
Such a wealth of experience.
Thank you. Well, I've enjoyed it immensely, as I generally do. And maybe we'll come back in 3 months' time or 6 months' time and have another look.
Definitely. That would be superb. And for all our listeners, there's a fantastic library of over 100 PIWORLD interviews, including those from Richard and other eminent investors, at piworld.co.uk under the PI Wisdom tab, both as a video and a podcast. Thanks for listening, and stay well.